All right, so in this video, I'm going to talk a little bit about the stock cycle importance as it relates to corporate finance. So, as I've discussed in a prior video, earnings and cash flows that are produced by a firm are directly related to the firm's stock price. So, that means trends in the earnings and cash flow are going to be important factors that are also going to drive stock prices. And if, as the company, you're focused on trying to maximize long-term shareholder wealth, which is going to be very much influenced by the stock price, trends in those cash flows and earnings are going to matter. So we have to understand the nature of those trends and kind of what causes some of those trends as well. So some of those trends would be caused perhaps by changes in the industry, changes in the company, and so forth. But some of it is also caused by trends in the economy and so forth. So we're trying to kind of maximize long-term shareholder wealth, and that's going to be one of the reasons we're going to care about what happens in the stock market cycle. Now, it's also worth noting that there's kind of a saying, a rising tide floats all boats. And so the reason why I'm noting that in this context is because sometimes you can kind of get sucked into the idea that like, oh, well, we're doing so well because everything's improving. Well, could just be the entire economy is improving. And so if the entire economy is improving, then the proverbial tide is rising and your boat is floating because the tide is going up, not necessarily because you made wise choices. So you have to be a little bit cautious about what you're assuming when things appear to be improving for your business. Is it really because you made wise choices, or is it just because circumstances have improved? Um, Now, I'm going to borrow a quote from Warren Buffett in Berkshire Hathaway's 2001 annual report, and in which he stated, "After all, you only find out who is swimming naked when the tide goes out." And the idea there is basically that poor choices can be masked by good economic circumstances, basically. So, in other words, when the tide is high, everything looks good and certain things are covered up. And so if you made some not so great choices, it's not as obvious. It's kind of covered up a little bit by the fact that, or glossed over by the fact things have been going well. But when you made some of those questionable choices and the proverbial tide goes out, and so in other words, the economy maybe goes into a recession or something of that nature, well, that's when you find out what companies were making questionable choices. So from that standpoint, you kind of want to prepare for those bad circumstances because you're going to find out whether or not you did a good job managing the firm when those bad circumstances arise. And so that leads to kind of what I'm noting here as sort of a tempting illusion, the idea that you can kind of look at the circumstances for your business and think, wow, we finally made it. We've done such a brilliant job with our planning. Our strategic plan has worked out marvelously. Just look how much growth we've had. This is fantastic. When a lot of it might have just been, hey, entire economy's been growing well, or maybe the entire industry's been exploding, right? So if your business is growing by 20% a year, that sounds fantastic, unless maybe the industry's growing at like 22% a year, in which case actually you're technically below average. So you have to be a little bit careful of what assumptions you're drawing from the data. And so that's where it's helpful to kind of look at that bigger context before you make some assumptions. To kind of illustrate that point, I had a friend who was working for Radio Shack a number of years ago. So it was around 2005, 2006. And what he reported to me was that his manager at the time stated, Radio Shack is not affected by the economy. Really? Is that so? Is that so? And obviously, I would argue that Radio Shack is very much affected by the economy, and Radio Shack did actually go through bankruptcy in 2015 and so forth. And that's not to say that Radio Shack as a whole, of course, was a disaster or anything. But it does kind of suggest that there are managers who just don't necessarily see that bigger picture. And I would argue that that's way more prevalent in businesses than we perhaps might like to believe. And it's easy to lose sight of that bigger picture of how the economy does affect our business and what it's doing and how well it's doing and so forth. So from that perspective, hopefully you kind of pause a little bit when you're assessing your business and you're thoughtful about kind of how the economy and the stock market cycle and things like that actually are influencing you. So just as sort of a word of note there and caution. All right, so another little few notes to kind of carry this on a little bit more. So I'm going to kind of break the stock market cycle into a series of phases in subsequent videos. And I'm going to use those names for phases just for the sake of convenience. They're not necessarily like standardized names of phases, okay? But the conditions and circumstances and how things kind of progress, that's a lot more well understood generally. So don't get too attached to a particular phase that I'm discussing in the sense of like the name of the phase. Make sure you're more paying attention to what's happening during the phase and so forth, because that is something that's definitely more understood generally. But with that little brief introduction here, a firm, its customers, and its suppliers are likely going to fit into one or more phases. In other words, they're going to tend to be more influenced positively during certain economic environments, basically. And so from that perspective, if you're working for a firm, it's probably going to thrive better in certain economic circumstances than others. And if your customers, they're probably going to thrive better in certain economic circumstances than others. And that may lead to an interesting question, which is, so as a firm, could you diversify into maybe a different phase and maybe be influenced by different economic circumstances? And the answer is maybe you could. Maybe you could find something that your business does. It's part of its core competency, something it does better than other companies. And maybe you could use that to produce some other kind of product or service that tends to do better in different economic circumstances. And if you could do that, then that might sort of smooth out fluctuations in the economy for your business. So your business wouldn't be quite as drastically affected. That's a possibility. And if that's the case, perhaps this is even lowering the risk for your business, which is good. So I think you have to kind of address that question, which is, what is the firm's core competency? What are we really good at that we're better at than our competitors? That gives us a sustainable competitive advantage that we can do better long term. And is there some way that I can use that for something that might perhaps do better in different economic circumstances? Now, there is possibly a trade-off between diversification and distraction. And what I mean by that is, for a lot of businesses, if you just start diversifying into every kind of product and service under the sun, on the one hand, you might be able to create a conglomerate that is diversified so that you have things, products, and services that would do well almost regardless of what's going on in the economy. I mean, if the economy is bad, you have products that people buy when the economy is bad. And you have products people buy when the economy is good. And you have products people buy when inflation's high. And basically you can diversify across all those things, and that might help to create quite a bit of diversification. And that sounds kind of nice. The downside of that is you run the risk of distraction. And so from that perspective, generally, if you start doing that, you might have a situation in which you just aren't able to focus on anything particularly well. And so you're focused on so many different things that you don't do anything particularly well, and you wind up doing poorly as a result for a business. So you have to be mindful of that balance between the diversification and the distraction. And let's make sure that if we're doing some diversification, it's not coming at such a cost in the sense of distraction that it is damaging the sustainable competitive advantage of the firm and so forth. Also, another reason why you might care about this from a corporate finance standpoint would be to use the cycle to your advantage, and in this case, perhaps to expand opportunistically. So in other words, maybe you expand when the economy is doing poorly, and expansion is relatively cheap because nobody else is buying equipment, nobody else is buying buildings and land because the economy looks lousy, and so you expand when everything's cheap. And so that's possibly very advantageous. You might also try to avoid foolish decisions, such as expanding out straight at the top of the market, and then when the economy is roaring along, and everything's more expensive because everybody's expanding and everybody's buying land and everybody's building buildings and investing in equipment. And so maybe we can try to avoid those kind of decisions. Now, the discussion in the subsequent videos that I'm going to have here is not to suggest that you could figure out exactly where the top of a stock or economic cycle is, or exactly where the bottom of a stock or economic cycle is. That's not what I'm suggesting. But if you can better understand what those economic circumstances are, you might be able to be wiser about the choices that you're making and perhaps tilt the odds in your favor a little bit so that you're a little bit more likely to be doing something like an expansion closer to the bottom. And you are preparing for when things might fall apart, when things kind of look like you might be closer to a top, and you're positioning your firm well. Not to say that you're able to figure out exactly where the top is or exactly where the bottom is, because lots of people have tried to figure out exactly where the top is and exactly where the bottom is, and people have gotten it wrong. So this is more of maybe you can better position your firm based on those circumstances, kind of an idea. All right, hopefully this video has been helpful. Thank you so much for watching. Have a great day.